Hey everybody, it's Ken McElroy here, and I'm very excited to have Anton from Peak Financing because, as you guys know, the Fed's doing a lot of stuff. There's a lot of commercial real estate in trouble, and of course, everybody's scratching their head about residential as well. So I wanted to get into all of those topics today. Anton, welcome back. Good seeing you again.
Yeah, hi Kenny. Yeah, same here. It was great seeing you at the Real Estate Guys Summit. Unfortunately, I missed you at Limitless. I heard it was a great event that you had, and I look forward to see you next year there.
Well, listen, we've got the Fed, basically saying they've got a couple quarter-point rate increases. They've raised rates 10 times. It's really put things on hold. As you know, our acquisition team, we're still fighting for deals, but there's a big disconnect between sellers and buyers. And I'd like to know, if we could start right off the bat, what's your crystal ball? Because, all these syndicators, all these property owners, landlords, they all go to companies like yours. And I'm sure that you get to look under the hood for real, like you get the real data, the real financials, and the real occupancies, the real management issues. So what's happening right now in the industry?
Yeah, it's really interesting, right? Obviously, you're in multifamily. A lot of the loans that we are arranging are also on the multifamily side. We do any commercial real estate, but the multifamily side is only a big piece of where we are involved in. And in that segment, we also work with a lot of syndicators. And as you know, and you have touched on this many times on your podcasts and on seminars and presentations, a lot of these properties by syndicators were bought in the past with agency loans, which was the right thing to do in most cases. And then because the price increases were so massive, everyone in 2021 shifted over to bridge loans. Obviously, everyone was arguing, well, it's a value-add property. That's why we do bridge loans. But the reality is many of these deals still would have qualified for agency loans, but only at maybe 50 or 55% leverage, which never works really for a syndicator. So as a result, virtually everyone went for bridge loans. The smart ones, they went with lower leverage, maybe around 70% LTC. The not so smart ones went with 80% LTC. And on top of that, very often added pref equity. And the ones that were the least smart also didn't buy interest rate caps, right? So you have different pockets there. Some of them were, I think, are still perfectly fine, even if they had to refinance. But the others with maximum leverage, pref equity, and or no rate cap, they are in trouble. There is no doubt about it.
Well, you covered a lot there. So let me just unpack a little bit of it. So what Anton is saying is there are fixed rate options and there were floating rate options way back, and people had both choices, but the fixed rate option required more money down, but it had, any potential rate increases, whereas the variable rate options or the bridge loans, they required less money down, and of course they had this big value add component. So, and at the time, Anton, I think that a lot of people, they weren't looking at it as the risks beyond. They were always thinking that the market was just going to continue to go up. And so those are the folks that are in trouble right now. And then you touched on rate caps. So everyone who's listening, how that works is that while you're doing the loan, it's like an insurance policy. It basically caps the rate. And at the time, Anton, those are pretty cheap. I want to say they were 25 or 50 grand or something at the time. And now they're in the millions as a result of, essentially it would have been just like any kind of an insurance policy for your loan. And a lot of the inexperienced syndicators did not get that. So there were two things that happened. One is rates went up and two, values went down. So now they're sitting in these these real estate deals where they had a value add, but the cap rates have gone up. So now there is no value add, and then the rates have gone up. So that's essentially, I do want to get into LTC or loan to cost and LTV and debt service coverages and stuff too. But so we're talking about billions of dollars of loans on assets where the rate caps are starting to expire. I think I read like the second half of this year, there's a fair amount of rate caps expiring. So one, if they have rate caps at all, there's a time frame on rate caps, and as you know, Anton, they can come due. So can you talk a little bit about that? Because we're talking about some pretty big checks that are going to have to be written, or properties are going to have to be recapitalized somehow, right?
Yes, absolutely. Right. You mentioned earlier, during that time, it was pretty cheap to buy a rate cap. Let's say for 10 million in 2021, it was not uncommon to pay 40,000, 50,000 for that, for a 3-year rate cap at 1.5%. Right. And that was a very common structure, because the short-term rates back then, which was the SOFR, which is the base rate that essentially every lender is using, which is very closely tied to the Fed rate as a short-term rate for commercial borrowers. So that was virtually at zero, at 0.05, 0.1%. So everyone bought a protection at 1.5, maybe at 2% rate cap, thinking, well, that will be sufficient. The lender was comfortable with that, even with that additional increase. So if you had, let's say, a spread over your SOFR of 3%, which was the best that you could achieve as a strong borrower and for a larger deal, so your whole starting rate may have been just around 3.1%. And even with that protection, that insurance, it would have been still capped at 1.5%. That's that insurance cap plus the 3%. So you would still be at 4.5%. So everyone was underwriting to that, and that was fine. And the problem now is that if you are not able to refinance, and many of these deals cannot be refinanced because the exit rate with an agency loan is much higher now, and operationally we can touch on that too. A lot of people struggle. Now they have to likely extend that bridge loan or the rate cap. And the same rate cap at 1.5%, let's say, for a 10 million loan today would be around 380,000 for 1 year. Before, that was for 3 years. For 2 years, the rate cap was even less. That may have been just 25,000, right? So even if you just extend it for 1 year, it's 380,000.
Yeah. So you bring up some really, really good points here. So what we have, guys, is a lot of the real estate. Let's put some numbers around this. Let's say I went to Anton and I was buying a $50 million asset. It doesn't matter if it's a retail building, an office building, a multifamily building. It doesn't matter. I would put a down payment on that, let's say 15 million, and then their 35 million would be the debt. So that debt at that time, a lot of people were taking this bridge scenario. Well, what happened was the cost of the mortgage payment went up so much because rates went up that there's no cash flow. And so they're now in a position to where they're having to cash call or sell. The real issue, Anton, as you know, is as rates go up, cap rates also go up. Although a lot of people try to tie the two together, they're not really tied together. In my opinion, what happens is as rates go up, people like us, like as a buyer, we have to pay less to get the same cash flow because the cost of our debt is more. So we're offering less, and the sellers are now coming to grips with having to sell for less. And so because of that, then now cap rates are going up. The problem with that is that this all just happened in the last year, is that if I bought that $50 million building and I thought that it was going to be worth 60, it might now be worth 35. Because cap rates, let's say, went from 4 to 5, which is, let's say, 20%, which is, I guess, 10%. So that would be, let's say, it went from 50 to 40. So instead of it going from 50 to 60, it went from 50 to 40. Therefore, the equity's wiped out, and Anton now is trying to size that loan again to the new value. And I think so that's actually the issue, is that that $50 million asset is, say, worth 40. And so Anton is now taking a look at an asset that's now worth 40, and Anton's probably can only put about 20 on it. So there's a $15 million problem with that asset. And so, that's kind of, wouldn't you say that's kind of the general problem that the whole industry is having at the moment?
Yes, that's certainly one of the key problems.
Can you walk through the ripple effects? Because it looks to me like San Francisco is kind of leading the pack. Seattle, Portland, or New York. I think I read Atlanta, Dallas. And you're in Houston, I think, right?
In Dallas.
Dallas, yeah. So you're probably seeing it firsthand, right? And that's going to make its way into these. People think that the big banks own a lot of that stuff, but you'd be very surprised that it's the small and regional banks that actually have a lot of those loans, right?
Yes, that's right. And the smaller and regional banks really picked up the commercial loan activity significantly between 2021 and 2022 because they saw an opportunity there, right? There was also a lot of, at that point, there were still a lot of deposits, right? Because interest rates were still low. So deposits were not an issue. They turned to become an issue once the Fed started to raise rates. Now, the problem with banks is that they are regulated, right? So they do not have the freedom just to do whatever they want. And unlike private equity funds and debt funds that are free to structure deals the way they see fit, and as long as investors are willing to take the risk, they can do this. With banks, they are regulated and they need to follow these rules. So the more bad debts they have on the book, and by the way, very few loans that banks originate are securitized. And if they put it off their book, very often they sell it to another bank, right? So it is not that it leaves the banking system, it just goes from one bank to another bank. And so all of these banks now have these office, on the forefront, definitely office buildings that are going to be a problem. And they still have the capital ratios that they need to maintain. So what do they need to do? Yes, they can raise equity, but now nobody wants to give a new equity to a bank that is already in trouble. So now they need to look for opportunities to dispose other valuable assets, right? And eventually they may have to sell off some of the multifamily loans at a discount. They definitely have to sell off a significant portion of the office building loans at a significant discount. And if no one wants to buy them, they need to foreclose on these. But even if they are able to sell the loans, whoever buys those loans will likely foreclose on those loans too. So that is unfortunately what's happening. And with that environment, naturally, they are all under credit constraint themselves with all the capital ratios, so they cannot lend more money. And as you mentioned, deposits are a real challenge for these banks. They do not win as many deposits as they need. And as a result, they just, by regulatory influence or enable to lend additional money.
Yep, you got that right. So that's a great point to end on. Anton, what's the best way people can reach you? This has been fabulous, great information. Let's do this again after we see some of these rate caps expire and we kind of see what happens with these next two increases. What's the best way people can reach you?
Yes, so the easiest is by my email. So that's Anton, so Anton at peakfinancing.com. You will find me on social media, LinkedIn, Twitter, Facebook. So pretty easy to reach. By the way, we are launching separately alternative investors social network that is only for verified investors within the next few weeks, which is actually intending for a social network for investors that they can have that discussion about deals and how they can deal with situations that they are in.
Thank you, and can't wait to have you back on soon.